Hyun Song-shin. He's an economic advisor and head of the Monetary and Economics Department at the Bank for International Settlements, the B.I.S. Before joining the B.I.S., he was the Hughes Rogers Professor of Economics at Princeton University. Before that, he was our colleague at the LSE, at the Finance Department. And before that, he was at Oxford. Hyun is an intellectual leader in the fields of banking, in international finance, monetary economics, game theory, global games, you name it. So topics on which he has published widely in prestigious academic journals as well as in the policy area. Hyun's, one of his areas of his recent focus has been to develop the B.I.S. work agenda on digital innovation in the financial system. And he was part of the B.I.S. management team that developed the B.I.S. Innovation Hub and served as an interim head at its launch in 2019. He has also served as a senior advisor to the Korean president, taking a leading role in formulating financial stability policy in Korea and developing the agenda for the G20 during Korea's presidency. Hyun is an excellent choice for the Goodhart Lecture. He, like Charles, he combines deep economic insights and very well respected, highly respected academic research with policy relevance in his role as, especially as chief economist of the B.I.S. So, Hyun, over to you. Let us welcome Hyun.
It's great to be back in this room, actually. I mean, LSE holds so many good memories for me. It's wonderful to be back. I think I spent the most productive time of my career when I was here, and it's a double pleasure to deliver this presentation in honor of Charles, my friend and mentor. I mean, pretty much everything that I know was learned from Charles. So what I've done is to put together a few slides on changes in the global financial system. So I'll say a few words about structural changes in the global financial system and some new trends that have emerged that I think would be very important for us to bear in mind in trying to understand events in financial markets right now. I think the backdrop is that the great financial crisis was really a watershed event. It set in motion some forces that I think have really defined where we are today. And let me begin with this chart, which is the way that essentially the traditional banking system, especially the broker-dealer sector, has actually evolved. What this chart shows is the total assets of three sectors in the US: households, non-financial corporates, and broker-dealers. It's all normalized to 100 at the beginning of 1990, and just track how large they became. You see that the yellow, which is the security broker-dealer, really grew much faster than the other sectors in the economy. And when Charles and I were writing the Geneva report on banking regulation, this was just after this point. Leverage that total assets had grown tenfold relative to 1990. And then, of course, it shrank very fast thereafter. The other sectors have grown in the meanwhile, and now they're pretty much again, keeping pace, having had this very big round trip. So one of the things that we worked on when Charles and I wrote the Geneva report was the importance of keeping track of leverage in the regulated financial sector. If you can keep track of that, you would go a long way to actually measure the risks and to see the extent of risk taking. If we look at the leverage of the sector, of course, that actually keeps, it has a roughly similar pattern to the total assets, but of course, equity has grown in the meanwhile. So leverage has stayed low throughout. So if you look at this chart, you might think, well, it means that the intermediation is not happening through the through the traditional broker-dealer sector anymore. So where has it migrated to? I think that's a very natural question that we can ask. And it, I think, motivates the structural change discussion that we'll be having. So to simplify, before the GFC, we could say the focus was very much on private sector claims, especially mortgages. And banks and broker-dealers were really very much at the center of the story because it was the assets that were held on balance sheet or warehoused through the special purpose vehicles. That's where all the action was. That's where all the risk was residing. And the lesson that we learned looking back was, well, we should have been keeping track of this. And when leverage reached 50, we should have sort of noticed that there was something unusual going on. And so why don't we learn that lesson, and going forward, let's make sure that we keep track of these balance sheets. I think that was the lesson that we learned. And subsequently, that lesson was incorporated into the various financial stability monitoring exercises at central banks, at the FSB. So this was the story. Now, what's happened since, though, is that there's been this rather profound structural shift. So rather than private sector claims, at the center of the financial markets these days are sovereign bonds. It's really the claims on the government rather than the claims on the private sector that has really taken center stage. It's still financial markets, but the intermediaries have also changed. So it's clearly not the same players that we had before, because they've obviously shrunk. But what I'm going to say later is that this shrinking, this apparent shrinking, should not be taken at face value. To some extent, there is also an accounting element here which obscures the true nature of the intermediation. But anyway, this is a theme that I'd like to explore today. So why do I say that it's the credit to the government that's really taken hold? Well, this chart is a weighted average of the credit to the private sector, the private non-financial sector in blue, and the credit to the government in red, again normalized to 100 at the beginning of 2000. And it's weighted by GDP, PPP GDP, of a number of economies, including the largest ones. And what you see here is that, exactly as we saw, before the GFC, it was the private sector claims that were growing faster. But then after the GFC, and they cross exactly at 2009, it's the government claims that have grown much faster. And you see the big pickup here during COVID. Of course, that's when government spending really kicked in hard, and this is when, of course, a lot of the central bank operations also came in. If we look at the two largest economies, the US and the euro area, here the solid lines are the US, and the dotted lines are the euro area. You see that it's really primarily it's the US government bonds that have really grown really very, very fast. If you look at the euro area, the red dotted line for the euro area is actually pretty subdued. So in spite of what we say about, the fiscal situation of the euro area is very challenged, and this is something that we need to keep an eye on. In fact, of course, they started off with higher debt to GDP levels than the US did, but it hasn't grown as fast as the US has. And it's very much a kind of a few economies, one of which is not the euro area. So the euro area has not been part of this. If we look at the instruments, there's also been a shift. There's been a shift away from loans towards market instruments, to marketable securities, to bonds. The blue line here is the loans for these economies, and the red is the government bond series. The purple is the corporate is the corporate bond series. It's the non-financial corporate debt security series. You see that, yes, corporate bonds have also grown, and it's grown faster than loans, but again, it's the government bond sector which has grown fastest. So this is a rather complex chart, but the message here is, again, it's the US. And for the euro area, in fact, the corporate bond growth has been quite lively. It's been quite quite a bit faster than the government bonds. Now, why does that matter? Well, the issuance needs to be held by someone, and part of it is is held domestically. But as we've seen in the last month or so, what's happening in capital markets is very much a global story. It's very much a global story where investors from all over the world are holding government bonds, issued wherever they are, especially in rich economies where you have large institutional investors, pension funds, insurance companies. They have obligations in domestic currency to their policyholders and to their beneficiaries. But because of their very large asset size, they have to have a globally diversified portfolio. And that means that they have assets in many different currencies. So it turns out that the foreign exchange market is absolutely essential. It's a crucial player in the story. And I'm going to focus on this for the bulk of this talk. And in particular, the foreign exchange swap market. Now, let me spend a couple of minutes on what they are so that we can sort of fix ideas. So think of an FX swap as a collateralized borrowing operation. Suppose I want to invest in some US dollar securities, but all I have are euros. Well, one way that I could do it is I can pledge some euros as collateral, borrow dollars, and use those dollars to invest in the US dollar securities. And then when it comes to the maturity of that collateralized loan, I would just roll it over. I would just update. So typically, FX swaps are short-term arrangements. So they are certainly much less than 1 year, sometimes even a few weeks, but typically not longer than 3 months. So here's an example. So there is a US dollar provider, let's say, so this would typically be a large US bank. And there's a euro provider, let's say a euro area pension fund. On the contracting date, the euro area pension fund delivers some euros at the current spot rate and then receives $100. And at the same time, they agree that at a fixed point in the future, they would reverse that transaction at a pre-agreed exchange rate. So the exchange rate that you would unwind that transaction is agreed at the contracting date. That's called a forward rate. And I'll come to forward rates later. This is a very simple kind of operation. So you might think, well, why would anyone want to do this? Because you're just giving one currency, receiving another, and then you're reversing that. Why on earth would you want to do that? Well, symmetric. So in contracting terms, this is a completely symmetric arrangement. But in economic terms, one side is borrowing one currency for use elsewhere. And because of the importance of the US dollar, it's typically the US dollar borrower that is actually, that's the economically more meaningful leg of this transaction. So what does the balance sheet look like with this, with this transaction? And this is important because this goes to my point earlier about the importance of accounting conventions and why we shouldn't look at those charts that I showed you about the broker-dealer sector at face value. So imagine that we have a euro area investor and has some euro deposits. So that's the initial situation. And then you enter into the swap. So remember, after the swap, what happens is that euro portion, so this blue portion suddenly becomes a green portion because now you have cash you have US dollars You have a US dollar deposit on the asset side. And then there's an off-balance sheet obligation. So because you agreed to unwind that transaction, so the forward leg of that swap is showing up as an off-balance sheet transaction. Now, although this is a collateralized borrowing operation for all intents and purposes, an FX swap is not counted as debt. Even though you're actually liable for the full face value, the full notional value of that contract, because it's an off-balance sheet, obligation, the accounting convention is to treat this not as debt, but simply off the balance sheet. So what this means is, if you're a bank and you've provided this kind of operation, it doesn't show up on your balance sheet as debt, and therefore it doesn't count towards your Basel III leverage ratio. It doesn't get picked up in capital flow numbers because capital flow numbers are typically derived from balance sheets. And so when I showed you that chart of the declining heft of the broker-dealer sector, to some extent that's due to the if you like, treating this as excluding this from the calculation of debt. The other thing, which is, I think, very important to understand, and this is something that Charles taught me, is that money is issued by banks, right? So so if you have deposits in a bank, that's money. And as Sarah knows, there's a singleness of money, which means it doesn't really matter what form of money you have in the economy. It's really just as good for payment, whether you have commercial bank money or whether you have a balance on your payment app or whether you have cash. What FX swaps do, actually, is to make money fungible across currencies. So you wake up one day and suddenly the blue euros that you had suddenly have turned into dollars. One day you had euro cash, next day you have dollars as a deposit, and it's money. This is why the banks are so important in this operation. It's just that there's this off-balance sheet obligation that, of course, the two parties keep track of, but it's not counted as debt. And of course, with that dollar cash balance, of course, you're going to do something with that. And typically, the story that I'm going to be focusing on today is, with the dollar balances that you have, you're going to buy a US dollar security, maybe a US Treasury security, corporate bond. And so this would be the final, this would be the destination after those sequence of transactions. So the euro holding investor has ended up with a US dollar security, but any kind of currency mismatch is offset by the fact that you have a dollar liability as well, but it's off balance sheet. Although there is no currency mismatch, there will typically be a maturity mismatch because your dollar obligation is coming due in a few weeks, in a couple of months, whereas your dollar security is probably a long-term security. And sometimes it could be, depending on what it is, it could be somewhat illiquid. So if you need to unwind this, you may find that it's less easy than you think. Now, why do I mention the accounting? Well, it's because this is a very, very large market. So the B.I.S. compiles data on FX swaps. The latest number, and these are semi-annual series. So every 6 months we compile the data. We have the new observation. We have $113 trillion of outstanding FX swaps. So it's swaps and forwards, but I'll just say FX swaps. So 113 trillion, if you think about it, is a pretty big number. Yeah. It's actually, if you think about any asset class out there, this is several times larger than that. One of the things we do is to show who the counterparty is in the FX swap. Now, of course, we get the data from the dealers, so one leg is always a dealer. The question is, who is on the other side of that FX swap? The yellow is when both sides are dealers. The blue is when the other side is a non-financial actor. So it could be an exporting firm, the textbook example of currency hedging, etc. But the really interesting part is the pink. So these are what's called other financial institutions. So other than the dealer banks. So these could be non-dealer banks, but typically they are asset managers, they are insurance companies, pension funds, the market players that we've come to know very well. And that part is the one that's grown fastest. So I showed you that 2009 was the watershed, right? That's when everything changed. Well, from 2009 until now, that portion has basically tripled in size. Yeah. Global GDP has grown something like 70%. This is a very, very rapid increase. And all of that is off balance sheet, and therefore it is not counted on any of the kind of balance sheet tracking sort of surveillance tools that we have. So one of the lessons actually that we took from the GFC was let's keep track of balance sheets, especially when they're growing very fast. Unfortunately, this is one of the lessons that we have to unlearn from this episode, because this is not showing up on the balance sheet. Even though economically these are, it's a collateralized borrowing operation. And it's big. But it's big because the capital markets are also big. If we look at the currency composition, again, it's the US dollar, which takes the lion's share. So if we take off the yellow, which is the dealer-to-dealer part, just look at the blue and the pink, the pink is like 60 trillion in total. Well, it's something in excess of 50 trillion is accounted for by the dollar on one side. Now, why would that be the case? Well, it's because, of course, there is a great deal of portfolio flows across economies. And so what this chart shows, this is one of the hexagon charts that we used to show the increase in the lending before the GFC. But this is the comparable hexagon chart for portfolio flows. And in particular, what this shows is the change in portfolio holdings cross-border between 2015 and 2023. So these are changes. So the red here indicates declines. The green indicates increases. What's interesting is, if you look at this chart, there is only a very loose relationship with the current account and the net positions. Portfolio holdings are the gross positions. So in particular, the largest investors in US securities are actually Europeans. China is over here. Japan is over here. So obviously they also have a large position, and it's increased somewhat. But the gross positions tend to be very much between the advanced economies. So this is very much the same lesson as the story about the GFC. If we look at the banking flows during the GFC, there was this round trip trade from Europe to the US and then back to Europe. So European banks were raising dollar funding in the US to invest in mortgage-backed securities. And so you had this round tripping. And of course, between the US and Europe, the current account balance was close to balance. But in fact, that's where the big gross flows were, and that's what actually eventually unwound. And something similar is also happening here. Now, why am I showing the changes rather than the levels? Well, one of the quirks of the international data on portfolios is that reserve holdings are not part of these measures. So central bank reserves are not included. It's still okay to use this, because if we look at the composition of portfolio flows between official holders and private holders. So the pink are the official holders of US Treasury securities. The blue is the private holders. The increase since around 2012 has all been in the blue, in the private holders. In fact, if anything, the official holding has actually declined somewhat. And the blue line shows the proportion of the non-official holders, and that and it's now close to 50%. So when I show you this chart, these green lines pretty much are a faithful reflection of the total flows, including the official flows. So I think the point to take away from this is, we read a lot about the importance of current accounts, about the net flows, and it comes from, I think, a more macro approach. Ricardo, I think, in macro, of course, capital flows are the residual to consumption and investment decisions, and I think that's where this intuition really comes. But if you're interested in financial conditions, how things actually move, it's important to look at the gross flows, and that's, I think, the lesson that we can draw from this. So here are some of the things we can learn. So what do we know about the capital inflows into the US? Now, typically when we talk about capital flows, this is an emerging market topic. We say, well, capital flows go into the emerging markets and they sort of rush out during stress. Well, let's look at the portfolio inflows to the US, because I think that's really probably the most important issue out there in capital markets right now. Well, FX swaps turn out to be very useful in explaining portfolio flows into the US. So the US Treasury publishes the tick data in portfolio holdings. So this is the growth rate of portfolio flows, of foreign portfolio flows into the US. And on the vertical axis, it's the growth of the FX swaps. And it does a passable job. Now, of course, we can refine this further because, sometimes the hedge ratios are lower, sometimes hedge ratios are higher. This is very much the topic of conversation right now, because the question is, how high are the hedge ratios? If you're unhedged and you're exposed to exchange rate movements, you may find that you have to join the scramble in hedging ex post. So hedge ratios will tend to be lower when the dollar is strengthening. Why would you hedge when you can win on both the exchange rate as well as the higher yields? It's also going to depend on the cost of hedging, and cost of hedging depends on the short-term rate. When short-term rates are high, cost of hedging is also high, and then hedge ratios would actually be lower. And so if you control for that, it's a very simple control for this calculation of the slope of the yield curve between the two, for the US and for the investing country. You get something that fits much better. This is something that I'm currently working with some B.I.S. co-authors. It's also true currency by currency. So, we can look at the tick data and look at what happens to euro area holdings of US government securities, and then look at the changes in swaps with euro on one side. We have exactly the same relationship in euros and euro area flows to the US. This is for Japanese holdings with FX swaps in yen. This is UK holdings and FX swaps in sterling. And the last one is Swiss. The portfolio flows from Switzerland and the change in the FX swaps. So there is a lot of information here. There's a lot of information in the FX swap data on portfolio flows. Now, what this also suggests is that during periods of rapid capital inflows, we know that that's going to raise asset prices, it's going to tighten spreads, it's going to loosen financial conditions. That's exactly what we find. So if you take a measure of financial conditions, and here I'm just showing you the Goldman Sachs Financial Conditions Index, just the annual change of that index, and the way that they measure it is when the red line goes up, this is when financial conditions are tightening. There is this negative relationship between FX swaps and financial conditions. So because FX swaps are associated with portfolio inflows into the US, this tends to loosen financial conditions in the US. And conversely, when FX swaps really decline, this is associated with portfolio outflows, and that's going to tighten financial conditions. So we have this triangle now. So the story that I've told you so far is, if we can track FX swaps growth, it's going to tell us something about portfolio flows, but it's also going to tell us something interesting about financial conditions. So there is this, this triangle where, although it looks very esoteric, it actually tells you a lot about financial conditions and what's happening in the market. So let's just plot that triangle. So the yellow is the annual change in the Goldman Sachs Financial Conditions Index. The blue line is the equivalent FX swaps, and the red line is the portfolio flows. And we see that there's a very good fit between FX swaps and with financial conditions, and also with portfolio flows. Now, if you dig into the financial conditions index a little bit further, it's the way that they construct it is to take 5 variables. It's the short rate, the long rate, there's a spread variable, it's a corporate bond spread variable, there's the equity index, and then there's the exchange rate, there's a broad dollar index. When these lines go up, that's when financial conditions tighten. So what's happened recently is that these lines have really diverged. So according to some measures, financial conditions are tight. According to other measures, financial conditions are very loose. So if you're tracking the equity market, financial conditions are very, very loose. If you're tracking the policy rate, financial conditions are very tight. And this has been this has been part of the conundrum actually for central bankers. How is it that we have this very, very loose conditions according to some measures, but tight conditions according to other measures? Well, so one thing that we've been doing is to try and see whether we can extract some patterns that make some sense. And there is a paper that's forthcoming that builds a dynamic factor model. It's like a principal component exercise. Let's take a large number of variables and see whether we can extract some common factors. And let's see what the factor loadings are, and see whether we can interpret those factor loadings in telling a story about what it could mean. But it turns out that 2 factors really sort of jump out. The first factor loads on short-term rates, safe yields, risky yields, and bank rates. So when those rates go up, financial conditions tighten. So that's like a level of interest rate type of effect. But the really interesting factor is the second one. It actually loads on equities. So when equity is doing well, financial conditions are very loose. In particular, when spreads are widening, financial conditions really tighten, right? Conversely, when spreads tighten, financial conditions are very loose. And in fact, for short-term funding, it goes the other way. So it's when short-term rates are low, that you actually have tighter conditions in this, according to this measure. And this looks very much like a kind of risk appetite measure. So when we do the time series, the first factor looks like this. So according to the first factor, it was actually very tight before the GFC. And it's actually very tight in the last couple of years because policy rates are very high. When it was very loose was during the COVID period when rates were very, very low. If you look at the second factor, conditions were very tight during the GFC. It really spikes. And then actually, according to the second factor, conditions have been very loose recently. So in spite of the very high rates, conditions have been very loose. And this is reflecting this buoyant stock market, the very tight credit spreads. So there is this, we can actually extract some more information. And it turns out that it's this factor, it's the second factor that explains FX swaps growth. So I'm not going to show you that result. We do this exercise where we try and see what are the determinants of FX swaps growth. It's this factor. It's this risk-taking factor, which seems to be doing the big job. So I said that this is very relevant for what's going on. I mean, it's actually I think a very, very important story right now. So I think it's worth going through. Let me talk about ex-post hedging. So ex-post hedging is where you enter the market without much of a hedge, and then you react to events by putting on hedges after the event. So suppose that you're a euro-based investor and you had bought a dollar security without any hedging. So this is your initial balance sheet. And then you suddenly find that markets are moving in an unfavorable direction. So dollar's falling, this securities are not doing very well. Well, one thing you can do is to enter a swap. So you acquire, exactly as before, you acquire dollar deposits, you gain this off-balance sheet obligation to repay the dollar. In the story before, this investor actually bought a US security with the US dollar deposit. Now, this investor says, I'm just going to sell that in the spot market. I'm just going to sell that and acquire a euro deposit instead. So what's just happened? I've suddenly got an off-balance sheet US dollar obligation, and that exactly hedges my US dollar security. So I've now hedged the currency risk. But you've done that by putting downward pressure on the exchange rate because you've sold the dollar and you've bought the euro. Now, when you have a situation where the hedge ratios are very low and the market is moving against you, this kind of very defensive action is a tactical operation. It's not changing your strategic asset allocation, but of course, this is something that you could certainly think about doing in order to protect yourself against further movements. And so, do we see some evidence in that? What should we expect to see in that case? Well, we should expect to see some relationship between FX swaps and the exchange rate. That's exactly what we see. So when FX swaps go up, that's when the dollar depreciates. So you can either read this as an explanation for how the exchange rate moves, or you could do it the other way, because everything is endogenous here. So I'm just telling you the story, but obviously to get past the referee, you'd need to show much more than simply a scatter chart. But you could also tell the story by saying when the dollar is weak, this is when risk-taking is also very prevalent. There's a risk-taking channel, which means that you will also want to hedge and go into US securities. Let me finish with the yen carry trade, because this is something that, of course, was very much in the news last summer. And everyone came to our webpage, and they discovered that lending in yen was actually pretty small. It's like only $250 billion worth, which is actually pretty small, compared to the size of the trade that people were talking about. But of course, they should have been looking at the FX swap data. So here's how you would engage in a carry trade using an FX swap. You would do exactly the same as in the ex-post hedging. So suppose I am a dollar-based investor. I provide dollars and acquire yen. I borrow yen on a collateralized basis. So I have this yen repayment obligation. But what I do is I sell the yen in the spot market. Rather than holding it to meet my obligation, I just sell it. And I would typically go through the dollar, but I could now go and buy an emerging market currency, and then I can just buy the government bond in that currency. And that would be a way that you could construct this kind of trade, where you're holding an emerging market government bond, but you have a yen obligation. And this, the FX swaps in yen is actually quite sizable. It's in yen here, so I've sort of expressed this in yen, but it's around 50 times larger than the on-balance sheet numbers. Now, of course, a lot of this would be Japanese investors, long investors wanting to buy US securities. So this is all mixed up here, but part of it will be, this kind of trade. And again, we would expect to see a negative relationship between the yen and the FX swap. So when would you see a huge increase in the FX swaps denominated in yen? Well, it's when the yen is weak, because then that's when you would enter this kind of trade with a swap. And because you're selling the yen, the more people enter this trade, the greater is the pressure to lower the yen. So there's a self-fulfilling element to this as well. And again, that comes out very strongly. So Dimitri, what I'll do is I'll just conclude. So I've just given you a little glimpse of this big structural change. So, we learned a lot from Charles's contributions, and I think they're still relevant. But what's happened since the GFC is that there have been some really very profound changes in the structure of the financial markets. I haven't even begun to tell you about the short-term funding market, the repo market, and the role of the hedge funds and all of that. I've just given you a little sort of glimpse of it. But the lesson is that we really need to take the government bond market and the foreign exchange market together, because these are global markets. And the FX swap market is really the linchpin that joins the two. So let me stop there, Dimitri, and then we could take some questions.
Okay. Thank you very much, Hyun, for your presentation.